we have a number of options for advising our clients as far as charitable donations go and the tax implications of them. So we in this video are going to walk through how we capture all of the different types of strategies, options for charitable donations. First, what we'll need to do is just capture a charitable donation. So that's going to be in Schedule A. So I started up top, I scrolled down to Schedule A. Where is it? There it is, Schedule A, which normally would be closed. I'll pop it open here, and here's a field for charity. Let's say that this client gives $30,000 to charity. You'll see right here that my standard deduction went from 24,800. Then when I put in 30,000 here, it knows that now I'm itemizing, so then my deduction becomes $30,000. That's how you capture just a plain old charitable donation itemized on Schedule A. Next, let's look at how a charitable deduction could be impacted by the client's AGI. Here we just wrote $30,000 and the system knew to itemize $30,000. But sometimes the AGI limits how much we can give to charity. So I'm going to clear this out, and I'm going to open up this little section here. This is the section that actually does that calculation for us. So if I scroll up a little bit, I put in a very simple case where this client's AGI, adjusted gross income, is $200,000. So now in this section here, let's do a huge charitable donation of, I don't know, $175,000. Now I'm going to hit tab, and I'm going to expect not all of that to be deductible because there's a limitation based on AGI. And here it is. I gave to a 50% limit charity, and it is only $100,000 or 50% of my AGI. There's AGI. Here's $100,000. Only $100,000 was deductible. And if I look at my itemized deductions, there it is, $100,000. As it happens, in the year 2020, because of the CARES Act passed in the spring, as far as we know, it's the year 2020 only, there is no limitation at this level for the 50% limit organization, a cash donation to a 50% limit organization. Look at that. I gave $200,000, which is equal to my AGI, and I was actually able to itemize, if I scroll down, itemize the entirety of that $200,000. So you just have to watch based on the client situation, whether you need to use this section or not. I will say that, let me show you, you can get caught out if you don't realize that, okay, so here the system is limiting me to $100,000, but I can actually override that. So remember that first field I used to enter charity. If I enter $175,000 down here, the system uses that as an override. It just says, well, for whatever reason, ignore this calculated amount and use this amount. And so it's kind of a shortcut. So if you don't want to do all the AGI stuff, you can enter an amount in here, or if for whatever reason you don't think the AGI piece will apply because whatever happens with AGI, just know that you might do that inadvertently. And so in this case, where the client is only able to deduct $100,000, I've overridden that and put $175,000. So you're going to have to know your client situation and act accordingly. Next, I want to show something that also is new to the year 2020 and beyond, and that is, so let's see if I've cleared that out properly. Yes. So I've got no charity entered right now. I've got the standard deduction of $24,800. Let's go ahead and enter a charitable amount, charitable donation of $25,000, which is more than the standard deduction. And I'm going to hit tab to save that. And what's interesting here is we still stayed with the charitable donation, or sorry, with the standard deduction, which is less than what we gave to charity, less than it by $200. But if I scroll up, recall that the CARES Act introduced this new feature, which is a $300 above the line charitable deduction if you take the standard deduction. So now the system is going to know that if basically my standard deduction plus $300, if that's more than what the itemized amount would be, it's going to take the standard deduction and put this charitable amount in here. So if I scroll back down here, I can actually get it to the point where it gets over the limit. So $26,000 Now it switches to itemized. Now that above the line deduction is gone. So just watch for that. If it's behaving in a way that you may not expect when there's charity and you expect to be in the itemized deduction range, check that above the line deduction piece that can max out at $300. One common technique that advisors use is donor-advised funds. A donor-advised fund allows you to group multiple years of charitable donations into a single year. And that's helpful when there's a situation where you might want to take a standard deduction in one year versus the itemized deduction in another year. So let's use an example. Let's assume that our client gives $20,000 to charity every year. That's their rough budget for charity. You'll notice that that is below the standard deduction amount. So this client never really gets to deduct this $20,000 given to charity. Now, what if I do this though? What if I create a donor advised fund, and this year I give 2 years worth of donations to charity, so $40,000. Well, now I'm getting a $40,000 itemized deduction. And then next year, let's make next year, because we were going to want to show the client how we're doing this. Copy from scenario 1. Let's make this 2021. Now in 2021, I'll scroll down here. I won't give anything to charity because I'm going to dole that out from the donor advised fund in 2021. And now look at this. My total deductions, instead of being roughly $24,800 plus $25,10, roughly $50,000 over the course of 2 years. Now I'm able to itemize 1 year, take the standard in another year, and now I'm getting roughly $65,000 in deductions rather than $50,000 in deductions. So I'm saving my client about $15,000 of taxable income just by using this donor advised fund. And this is how in Holistiplan you would model that and show it to the client. You could show them, look what I just did. I was allowing you to itemize this versus not. And this works in the other direction as well. This client gives $30,000 per year, so consistently they are itemizing, but they're not itemizing by an enormous amount over the standard deduction. So what we could do is double up. We could say, let's do $60,000 this year. So using a donor advised fund, let's then add our 2021 case here. In 2021, we'll use that donor advised fund to make those donations. And so then we'll take the standard deduction, so let me drop this to 0. So instead of having $30,000 per year of deduction, so $30,000 plus $30,000, a total of $60,000, I'm now able to get $60,000 plus the standard deduction in the next year. So it's a difference of $25,000 in deductions by using a donor advised fund to double up. Now, one thing to be careful of with donor advised funds, a couple things. One, that $300 above the line deduction, as far as we know, does not apply to donor advised funds. And also that special 2020 waiving of that limitation for 50% limit organizations, that does not apply for donor advised funds. And at the moment, at least in the software, we don't have like a checkbox that says this donation is donor advised fund versus not. That may need to change in the future depending on where the laws go, but in the meantime, you, the advisor, are going to have to make sure you note that as you build a scenario, make sure that you're capturing it properly. If you're giving to a donor advised fund and you're entering that amount in here, you are going to need to calculate outside the system that AGI limitation, which would still apply in that case. Another strategy available to a financial advisor, if the client is over age 70 and a half and if the client has IRA money, are qualified charitable distributions. With a QCD, qualified charitable distribution, the distribution is not taxable. It's a tax-free withdrawal from retirement. So especially in RMD years, that could be a pretty powerful tool. So let's use the software to show how that might be beneficial to the client, how we can demonstrate to the client. So let's keep this $40,000 in here. So let's say, okay, we're giving $40,000 to charity this year, And here is our tax bill, $26,730. If I scroll up, you'll notice that this client had $50,000 of taxable IRA distributions. So what we're going to do to try to capture the QCD route, I'm going to copy that base case forward. And so we're basically just comparing 2 years. Wages stay the same, but now we're going to direct $40,000 of our IRA distributions, maybe that was our RMD or something like that. We're going to direct $40,000 of that to charity. And so I dropped the taxable IRA distributions. And now, though, I need to make sure, I've seen even accountants not get this right, we need to make sure to remove that from Schedule A. So now instead of itemizing, we're taking the standard deduction here. So let's look at that. So we dropped our taxable IRA distributions. We're basically built into this IRA distribution assumption is 40,000 of it is tax-free, and so I dropped it by 40,000 versus the base case. I'm now taking the standard deduction, and let's look at the difference in tax. Look at that. I saved the client. It went from $26,000 to $21,000 in taxes. And I think that can surprise clients sometimes because they expect, well, isn't it the same? I mean, I get to deduct it versus get it tax-free out of the IRA, but it's always going to be, or as far as I've ever seen, it's going to be better to pull it out of the IRA above the line rather than try to deduct it below the line. And in this case, we're demonstrating to the client this advice to do a QCD just saved you $5,000 in taxes.